this is Chad Staskal, Managing Partner of Eagle Wealth, here with our March 2022 update. I'm here to talk about some of the most recent economic headlines and hopefully give you some insights into what those headlines could mean for you as an investor. But first, I have to acknowledge what a heartbreaking few weeks it's been as we watch these terrible events unfold in Ukraine. The rising tensions and the suffering of so many people weigh heavily on us. We hope and pray for the people of Ukraine and that this crisis can somehow be ended soon. The humanitarian crisis seems ever present in our hearts. But since this is an economic update, I want to discuss a little about what it means for our investment decisions. So how will this crisis affect inflation in our U.S. markets? Well, we expect the Ukrainian crisis will have a bigger impact on inflation than on growth. There are so many unknowns about the geopolitical and economic outcomes of the situation in Ukraine. But what we do believe is the impact on the U.S. economy will be relatively small. But inflationary pressures, which we're already running hot, are probably going to get hotter. The U.S. does not have much trade with Russia. The Russian economy is about 1.6 trillion in size. While that sounds big, that's only 7.2% of the size of the U.S., and it's ranked 11th in the world. Moreover, Russia plays a small role in the global supply chains. Can you even name a single product in your home that's made in Russia? But Russia is often called a commodity superstore. They are a large producer of energy, oil and natural gas, also food, especially wheat and corn, and many industrial metals. Fear of shortages has pushed up prices, which has made the headlines. For inflation estimates, energy composes 7.5% of the consumer price index. As for consumer spending, it's not as clean cut. As the cost of oil and gas move up, consumers have less disposable income to spend on other goods and services. However, there's some offsets. Households can dip into savings and liquid cash. Liquid cash is still at very high levels. And also, there's the offsettings of significant wage increases. How the higher energy prices impact discretionary spending depends on consumer attitudes and their willingness to go into savings or borrow money. So far, there hasn't been much of an effect. Oil prices have increased 35.2% in the past 6 months, while spending still remains very strong. So let's take a look at what is driving markets right now. Economic growth remains robust, which is keeping strong demand on hiring. Wages have moved up, attracting many non-workers back into the labor force. And despite the financial market volatility, the Fed just approved a 25 percentage point basis point rate hike. This is the first increase since December of 2018 and indicated an aggressive path forward with continued rate hikes for the rest of the year. Mortgage rates have increased 100 basis points or 1% since the beginning of the year, which should help slow down the demand and price appreciation of homes. Due to the receding spending on the pandemic, monthly revenues surpassed expenses for our U.S. government for the first time since September 2019. And then we look at the yearly change of inflation, which currently is at 7.9%, a rate that is just unsettling to consumers and the Fed. The recent surge in commodity prices are likely going to push that yearly change in inflation to higher levels over the next few months. But the strength of the U.S. consumer continues to put up strong demand on imports, which hit another record in January. So, despite better than expected earnings results, equity markets have entered into correction territory as uncertainty over the economic fallout from the Ukraine conflicts intensifies. While near-term headwinds have increased, the strength of underlying fundamental conditions should offer broader support to the stock market over the intermediate to longer term. Corrections tend not to become prolonged bear markets when the outlook for economic and corporate profit growth remains positive, which we currently have. The uncertainty, of course, is when does Russia stop its military advancement? And will there be any cutbacks in the Russian energy production and exports? High oil prices have a profound impact on the world economy, but it's far less severe for the US. We understand. Staying positive these days, it's a lot easier said than done. Inflation's running hot, gasoline prices are up, interest rates are climbing, and the Russian aggression toward Ukraine, there are so many reasons to be discouraged. One approach that we use that may help is separating issues into what you can and can't control. You can control your short-term and long-term goals. Short-term goals like saving for a summer vacation or a large household expense should still be on track despite the rocky start to 2022. Long-term goals benefit from the power of time and are probably still within reach. But if you're feeling uneasy about your goals, we're here for you, so to give us a call. And if you're looking for ways to help the Ukrainian people, check out our March 7th blog on the website for a link to some organizations doing good work that you can support. And now for that pesky mandatory disclosure. Please remember, nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, please feel free to give us a call. We'd be happy to talk with you. Once again, this is Chad Staskal with Eagle Wealth signing off for March 2022.